Alright, let's dive into something that's been bubbling under the surface lately, the fascinating connection between falling oil prices and the gold rally. Now, I know what you're thinking. What do oil prices have to do with gold? But stick with me, because this is where things get really interesting. Here's the hook: oil prices are dropping, and gold is surging. But why? And what does this mean for the bigger picture? Let's break it down. First, let's talk about oil. The recent dip in prices isn't just a random blip, it's tied to some major geopolitical moves. The U.S. and Iran are back at the negotiating table, and there's optimism about reopening the Strait of Hormuz, a critical shipping route. Personally, I think this is a big deal. The Strait of Hormuz is like the heartbeat of global oil supply, and any easing of tensions there is going to ripple through the markets. But here's the thing: even with this progress, oil prices aren't exactly crashing. They've snapped back a bit, but they're still way below their July peak. What's going on? Well, it's not just diplomacy. The International Energy Agency, IEA, has slashed its global oil demand forecast for 2026 by about 1.1 million barrels per day. Why? Because high oil prices have been crushing demand, especially in Asia. Think about it: when oil gets expensive, industries slow down, and that means less fuel consumption. It's a classic case of demand destruction, and it's keeping a lid on prices. Meanwhile, OPEC Plus is boosting production, adding more supply to the mix. So we've got lower demand and higher supply, a recipe for falling prices. Now, let's pivot to gold. Here's where things get really intriguing. Gold is often seen as a safe haven asset, especially during geopolitical turmoil. But what many people don't realize is that gold's performance is also tied to inflation and interest rates. When oil prices fall, it eases inflationary pressures. Why? Because cheaper oil means lower costs for manufacturing and transportation, which cools down the economy. And when inflation fears ease, central banks are less likely to hike interest rates. That's good news for gold, because higher interest rates make non-yielding assets like gold less attractive. But here's the kicker: gold isn't just reacting to oil prices. It's also benefiting from a weaker U.S. dollar. When the dollar softens, gold becomes cheaper for foreign buyers, and that's exactly what we're seeing right now. Central banks, especially in Asia, are loading up on gold, diversifying their reserves away from the dollar. In my opinion, this is a huge trend that's flying under the radar. It's not just about inflation or interest rates, it's about the shifting global financial landscape. Now, let's zoom out for a second. What does this all mean? From my perspective, it's a sign of how interconnected our global markets are. Oil prices, gold, inflation, interest rates, they're all pieces of the same puzzle. But what's really fascinating is how these pieces are moving right now. We've got falling oil prices supporting a gold rally, which in turn is being fueled by central bank buying and a weaker dollar. It's like a perfect storm for gold bulls. But here's the question: is this rally sustainable? Personally, I think it's too early to call. Yes, gold has surged to around $4,250 per ounce, and some analysts are bullish, predicting it could hit $4,500 or even $4,800. But let's not forget the bigger picture. The Federal Reserve is still a wild card. If inflation picks up again, or if the economy heats up, we could see more rate hikes, which would put pressure on gold. So while I'm optimistic in the short term, I'm also cautious about getting too carried away. What this really suggests is that we're in a period of transition. The global economy is still adjusting to post-pandemic realities, and markets are trying to find their footing. Oil prices are falling, but they're not collapsing. Gold is rallying, but it's not skyrocketing. It's a delicate balance, and one that's being influenced by everything from geopolitics to monetary policy. So, where does this leave us? In my opinion, it's a time to be both opportunistic and cautious. If you're a gold investor, this rally might be a signal to increase exposure, but it's not a green light to go all in. And if you're watching oil, keep an eye on those supply and demand dynamics. They're going to be key in the months ahead. Here's my closing thought. the relationship between oil and gold is more than just a market quirk. It's a reflection of the broader forces shaping our economy: geopolitical tensions, inflation, interest rates, and the shifting balance of power in the global financial system. So the next time you see oil prices drop or gold surge, don't just look at the numbers. Think about what they're telling you about the world we live in. Because in markets, as in life, everything is connected. What do you think? Is this gold rally here to stay, or is it just a blip? Let me know in the comments below.